Very good. Thanks for the opportunity to present. My presentation today, what I intend to do is talk a little about the benchmarking. Home Sacket have a benchmarking database where we benchmark between 150 and 200 farm businesses from across southeastern Australia annually, and I'll talk to a little bit about the data coming out of that. And then I'm really, given the brevity of the presentation today, I'm really just want to talk to some fundamentals in driving success in trading cattle enterprises. I've never seen a cattle trade fail on paper. And I'm not a market analyst, so already I've had lots of people saying, well, I'm really going to be interested in you telling me what to do. So I can't predict the future, so I can't tell you where prices are likely to be. If that's why you came, I apologise. But what I can do is couch what I present here with some numbers that may assist you in the decision-making process. So I'll get on with it. And clearly I don't know the technology. Down, there, okay. Look, I thought what I'd do is just start by looking at what our benchmarking data set has delivered over, in terms of outputs, over the last 5 years for trading cattle results. And you know, I talked about trading cattle never failing on paper. Well, the thing that stands out to me about the third year in that data series is that it failed pretty dismally, in my view, in 2013. With the lesson being that I guess be very careful when you go into any trade that you have done your numbers and you do know what the potential up and downsides are. Now, this data set, I want to talk about the data set a little bit because it's important that you understand some of the constraints around the data. In our benchmarking database, trading cattle enterprises are, generally speaking, are complementary. That is, we do not have many data sets that are trading cattle only enterprises. And that's important because I guess what we're looking at is the majority of these enterprises being complementary to a beef breeding enterprise generally occur when the seasons are better. So they supplement the good times to allow for capture of potential carrying capacity, if you like. So the last presentation talked to a comment that comes out of our data, which is in 60% of the profits come in, it's actually in 30% of the years, but I guess what these beef breeding enterprises do is when the times are good, they tend to go in, they tend to look at the trading opportunities and capitalise on them if they're appropriate. And that's important because often what you see is trading enterprises performing at considerable disparity to beef breeding enterprises, and that's partly because what we've got is a buyer sample. So this is the buyer sample, and what we're seeing there is this is the last 5 years only that I've presented, and one of the features, I guess, of this graph is firstly that it shows the woeful nature of beef enterprises to some extent, with net profits per DSE of $10 per DSE there, average. Having said that, the better performers always exceed that, and mostly, in many cases, may not double it per DSE, but certainly per hectare, they generally deliver double the profits. That's certainly the case also with trading cattle enterprises, and they've traded due to these last 2 years, particularly, that's boosted the average over the last 5 years, which has led to a $3 per DSE improvement over beef breeding enterprises. Now, that's all nice, but the reality is that either of those enterprises have not compared with sheep enterprises over the same period. The other point I want to make about about the 2015 year is what we're looking at there is the spring of 2014. So our data lacks or lags in terms of what you will be seeing in reality. So I think the best is in front of us, certainly with beef and the beef prices. What we're likely to see over the next few years of benchmarking is phenomenal results in beef, and if it's anything like what happened in sheep enterprises, I expect that we'll see large jumps, or those lines continue to increase in those beef enterprises, whilst the sheep enterprises will remain relatively stagnant. And this just goes some way to, you're all, I would imagine that you're all relatively familiar with the ECI type graphs. Well, this is my equivalent of the ECI graph. What I've got here is just the percentage of trading cattle benchmarking participants on this axis, and along the bottom I've got years, and this is the years where the sell to buy margin was greater than 40 cents. That is, you sold for 40 cents higher than you purchased those livestock for. And you can see in 2015 that 50% of the cohort made money through largely, or the trading margin was greater than 40 cents. So I think this reflects to some extent that over the last 3 years, if you haven't made money while you're trading cattle, you probably want to look at some fundamentals about growth and pasture and those sorts of things within your business, because certainly the market forces have been going with you. So how much weight gain is achieved in our data set? Well, all I've done is broken up the same cohort over the last 5 years, and again this comes down to my initial comment, I guess, which was you can always make trades work on paper. I think it's very important that when you are cattle trading that you actually document what sort of weight gains you're making and in what sort of years, because they should correspond fairly closely, because obviously it's all about matching weight gains to your pasture growth. So, but what we see is, people budgeting on very large numbers for weight gain with very little evidence in many cases to support the fact that they will achieve those sorts of rates of gain. And I think this sort of goes some way to looking at that. So all I've done here is again have the percentage of trading cattle benchmarkers along this axis running from 0 to 40, and along the bottom axis I've just put it into cohorts. So there's 12 or 15% that have achieved weight gains of under 100. Now that may have been their objective, that's fine. But I'll talk to the importance of weight gain in trades shortly. And then 100 to 150, is the largest cohort there, with over 35% of participants, and 100 to 150, 150 to 200. So those exceeding 200 are in the minority. If you're budgeting on that, have some data to support the fact that you will actually achieve that, because the outcome may be very sensitive to the weight gains that you achieve. Okay, I love this graph because it just looks like a few lumps, but this is the most important graph in livestock production in my view. If you are not doing, if you are not matching feed supply to feed demand, the reality is in a commodity-based industry, you are unlikely to be driving a low cost of production. And some of what I say will be at odds with some of the other speakers, and that's largely because the assumption that I am making for my presentation is that the thing that drives you is profitability. And that graph and matching your feed supply with feed demand are key components to driving profitability in agriculture. So the things I note of this graph, the first one is, where does the majority of your feed supply occur? It occurs in spring. That's the business end, that's the cheap feed. If you're not capitalising on that, start now. What's that mean? It means get your calving dates right in beef breeding enterprises. Make sure you got the right number of cattle there in beef trading enterprises. Where's the constriction? It's midwinter. Make sure that anything that you do matches your system so that you've got low midwinter stocking rates relative to higher average annual stocking rates at other times. And the other thing which I think is important, which isn't really reflected that much in this graph, is that you do have reasonable feed supply in autumn, but it's the variability around that feed supply in autumn that really is the difference between autumn and spring. And that's important when setting up systems. And finally, out this end, whilst this is a feed supply curve, the other important feature of this graph, I guess, is that it does tell you something about quality in southern Australia, and that curve doesn't differ that much across southeastern Australia. And the thing I note about that is that, feed supply is declining here, so that means feed quality is going to be declining. Why is that critical in a trading enterprise? Well, you want to have your cattle off by the time feed quality decline, because our experience and the benchmarking data shows that if you haven't, it's going to be a high cost from that point on. So I think setting up your trading system is all about this, and setting up your beef breeding system is all about this. Okay. So do higher prices lead to higher profits? Well, I think at a per head level they do. The question I asked, though, does it lead to higher profitability? And they're two different concepts. Profit is an absolute dollar figure. Profitability is about resource efficiency. So it's about the profit relative to how much capital you tie up to generate that profit. So on a per head level, all I've done here is made a whole lot of assumptions in a modelling exercise. But on this axis, this is just the net return before financing. And along the bottom axis, what I've got there is the sell to buy price margin. And all I've done here is just to demonstrate a point. I've compared the old price paradigm, and there's a paper there in your notes, with the new price paradigm, and I've got it up. I think in my scenario it was $3.30 in your notes, and it's just flown to $4. So I revised my modelling. But the message is, I guess, on a per head basis, yes, you will be better off. Now, there are a few constraints around that in this next slide, and all I'm showing there, the blue one is $4. The old buy price was $2.40, and I made some assumptions. Down here is sell to buy price margin. So, if you drop by 40 cents, you're still making dollars per head disparity from the new buy. That makes sense when you think about it, because you're now getting paid $4 on every kilo you produce rather than $2.40. So don't think I shouldn't be getting into the market because it seems too hot. Think about what the returns are. If it seems too hot and you think that it's going to go low, work out how much lower it's going to go before you actually take your position. Easier said than done. I appreciate that, because we are in times where I think we're effectively in unprecedented times in terms of pricing, and I don't think the historical data sets are going to give us much information about when it could go, how far it could go as well. So you do have to take a position on that, and I appreciate that's not always easy. So are returns on investment higher with higher prices, or better with higher prices? Well, this is an interesting, I thought it was interesting anyway, graph. Along this axis we've got return on investment, and return on investment in this scenario is actually I've looked at the net return after financing over all the costs, relative to all the costs. So it depends on the position that you take about the future as to whether you think it will actually you will actually generate better returns. So what you've got here is the old buy price of $2.40 and the new buy price of $4. Over the last little while, where prices have done this, as in the sell to buy price margin, I actually think probably the old prices have generated better returns on investment, because you're investing quite a lot more for every beast that you've got. So it is quite logical. But as into the future, the question is that the same? And I think out here what's happening is I think you'll actually make more if in a return investment perspective, if the margins are effectively negative in the future. So are you prepared? Look, I just thought I'd put this up. This is a useful slide in terms of in terms of working out where we are currently. What this slide shows is rainfall, winter rainfall versus spring pasture growth. I've taken the data from Bureau of Met and pastures from space. These data points, along here's winter rainfall. At Wagga so far we've had about 200 mils of rainfall, and I expect that we're going to get another 30 or so for the month. If that's the case, this is where we're going to end up if the correlation is as neat as that in the future. 5 tonnes of pasture growth. Who knows how much we grow a year in Wagga? It's around 6.5 according to this. So 5 tonnes of growth, and we've just had 500 kilos of additional growth through midwinter, or through May, June, July. Does it look better out there at the moment? Yes. Have you got surplus feed? If you do, now's the time to be making some serious decisions, because everyone will be making them in a month's time, and I don't think there'll be much margin. I don't even think there's much margin in a lot of what's out there at the moment. I'll fly through that. So what matters when you're trading cattle? Well, really I think there's a couple of things, and this is one of them. All I've done here is I've got the trading margin along this axis, and there's 2 components to the net margin in trading cattle. The first is the trading margin, and that's what you make out of the kilos that you purchase. Okay? If the market moves positively or negatively, you either make money or you lose money on the trade. That's the trading margin, on the kilos that you purchased. On the kilos that you produce, you'll make whatever the money is on offer. So it might be $4 per kilo. This is actually, I've under the assumption that you're buying today at $4 a kilo, and then I've just looked at the disparity. So you take a position on this graph, establish if you can buy cattle today at $4. If you sell them at $3.40 down here, if you buy heavy cattle, you'll actually take a bigger hit than you will if you buy lighter cattle. And that makes sense, because you're buying at a certain price and you're losing money on 350 kilos rather than 250 kilos. The trading margin is an important part of any trade that you do. Think about it before you make the trade. Now, yes, you have to take a position on whether you think the market will be here or here, because that line in the future, if you're on a 350 kilo steer, you'll be far better off if the market heads that way. And that's what's happened over the last 3 years. I won't tell you about my personal opinion because it's couched in absolutely no evidence. Other than market fundamentals, I guess, which are all we've got to act on. I think the other thing that's the important component to trading cattle is weight gain. You know, and it's no surprise. And all I did here was I thought, well, righto, I'll run a scenario on a 300 kilo steer, assuming I can buy it today. A 300 kilo steer with these margin scenarios. So you tell me whether it's going to be, and this was purchased at $4. You tell me whether you think the market's going to get to $4.40. If you do, then on 100 kilos, I think you can do probably about 150 from this point on. You've got 100 days of spring or thereabouts, 1.5 kilos. If you do that and you're somewhere in the middle, you'll do about 25%. I think we're probably going to be here somewhere. You're looking at about 10%. That suggests to me that trading steers, if you think the market's going to head that way, may not be the best thing to do for you. There are heaps. If you're a trader, you're a trader. You don't have to trade steers. Work out where the opportunities are within the market. Okay, my time is over, but look, I think I really just wanted to come up with a few key points. If you're a trader, trade the animals that provide you with the best margin. Your market view will frame your trading positions, but you need to take one. And don't take it ignorantly. Work out how far it can drop. It might be on trades made in April, the market could have dropped by 120 before you broke even, or 140 before you broke even. And weight gain is a profit driver, so make sure if you're in the trading game that you've got pasture quality to allow that weight gain that you're budgeting on. I'll leave it there. Thanks for the opportunity.